Welcome back. Now, the 3% inflation target announced by Reserve Bank Governor Lesetja Kganyago remains a contentious issue. The institution and the Finance Ministry are at odds about the matter, and while the governor has moved in to allay fears around the discord, economists have added their voices to the hymn sheet, with most agreeing that there may be more to gain and less to lose by lowering the target. Kevin Lings, chief economist at Stanlib, joins us with his analysis and view for greater perspective on the potential outcome of this action for both parties and the economy at large. Kevin, thanks so much for your time this afternoon. So following the MPC meeting about 2 weeks ago, there's been concern about some of Governor Kganyago's comments around the SARB moving to anchor inflation at 3%. What does this mean, right? In terms of his language in particular, is the SARB just simply anchoring inflation at the lower end of the target, or have we unofficially lowered the target to 3%?
So I guess we get into semantics around what the governor has actually said, but the reality is that the Reserve Bank is going to focus on getting a 3% outcome. The target is not officially changed. That can only be done by the Minister of Finance and with I guess broader approval, including, I would assume, the cabinet. But the governor is within his right to say, we've got a target range of 3 to 6, and I'm choosing to focus at the bottom end of that target range. I don't think there's anything wrong with it, and obviously at some point they did that by focusing on the 4.5%. So I think there's no real issue with it, other than if you're trying to achieve a 3% outcome and the government is not fully backing that, it makes your job a hell of a lot more difficult. There's no doubt that if the Minister of Finance endorsed the 3%, the cabinet endorsed the 3%, it was made an official target, it was resonating throughout society, then the chances of achieving that 3% is significantly enhanced, because you need inflation expectations to change. You need people to buy into this. Now, can I just highlight one of the key things is that a lot of contracts, a lot of official contracts, when they draw up the contract, they put into that contract that there will be an escalation in the price based on the inflation target. So if you keep it from 3% to 6% as your official target, then that contract can go up by a price anywhere between 3 and 6%. That's a valid increase. If you change the target to 3%, then contracts will be written that say you can only increase the price by the target, 3%. So it makes a huge difference to your ability to achieve the target over time.
And what have you made from of what we've heard out of government and Treasury, right? Before this meeting, it did seem like there was buy-in from Treasury, with Deputy Finman David Masondo even saying that an announcement on the target is imminent. And then post the last meeting, we got that statement from the Finance Minister, Inokorogwana, that was not in agreement of what the governor had mentioned.
I think that's right. So we know a couple of things, right? We know that there has been various working groups between the Reserve Bank and Treasury. We know that there's been a lot of work done in the background, especially by the Reserve Bank. We know that National Treasury was on board in terms of re-looking this issue. So I'm not convinced that there's a massive discord between Treasury and the Reserve Bank. I don't think that there's this huge chasm that is massively problematic. Where I think the difficulty is around the timing of when you go about doing this. And clearly National Treasury just doesn't feel that this is the appropriate time. Now, you've got to think about it a bit from National Treasury's perspective, because the Reserve Bank is saying that as you try and achieve this target, it's going to hurt the economy. It's going to it's going to dampen down tax revenue, it's going to dampen down economic growth, and there is a cost involved in trying to get the 3% achieved. Of course, the Reserve Bank is saying is once we get the 3% achieved, then the benefit far outweighs the cost. But in the short term, there's a cost. And I think from the Treasury's perspective, they're saying, well, this is not a good time for us to be incurring that sort of cost. We've got so many other issues we're trying to confront. The economy is already under desperate pressure. We're heading into a local government election. Is this the exact time we should be embarking on this? The Reserve Bank is saying, yes, we hear that, but from an inflation point of view, there's a great opportunity now to get the target reached because inflation is low. So let's not miss this opportunity. So I think what you've seen is a difference in timing of when to do this, not so much a difference in the benefits of a 3% or whether that is ideal. I would imagine the Minister of Finance can appreciate that 3% inflation target's a way better outcome than what we've got at the moment. But it's the timing of when and how you try to achieve that outcome.
Yeah, all we've been hearing is short-term pain for long-term gains. Now, with that being said, Kevin, I think there's been a lot of confusion around the impact of lowering the inflation target and what that might do to the current cutting cycle, right? In the scenario that Governor Lesetja Kganyago painted out 2 weeks ago, he did say in the medium to long term, we might see 5 rate cuts moving forward if we maintain that target. What does that mean for the current rating cycle? Does it mean that we are at the end of the cutting cycle for 2025?
Yes. So if you've been logical about this, then you would say there's no more interest rate cuts, that you are now trying to achieve 3%, that your own forecast shows that inflation will drift higher in the short term. Obviously, you don't want to be cutting interest rates while inflation is going up and moving further away from 3%. So logically, you would say, I'm going to keep interest rates where they are, and I'm going to use the interest rate at a high level in order to achieve 3% by the time we get to 2027. If we get there, if we can achieve this, then 2027, we're in a great position to cut interest rates fairly substantially. And as the governor's saying, potentially 5 cuts in interest rates. At that point, we would then reap the benefit because we would have a much, much lower cost of capital, and there would be other benefits in terms of currency, etc. So I think the Reserve Bank is saying that in the short term, the pain is we're going to keep interest rates relatively high in order to achieve this 3% in 2 years' time. So, yeah, we're not expecting any more interest rate cuts. Clearly, if things change dramatically, let's say that South Africa goes into an outright recession, let's say that inflation is even lower, yes, of course, circumstances change and then there's an option to cut rates. But as they stand at the moment, we're assuming interest rates stay where they are as we try and make progress towards now a different outcome.
Kevin, let's leave it there. Thanks so much for your time and sharing your insights. That was Kevin Lings, Chief Economist at Stanlib.